All right, my friends, so I'm going to share with you why you need to stay invested. It's easy now to throw in the towel and say, I'm out of here. In fact, I don't even know what the markets are doing today. Right now, it's 10:26 on, I don't even know what today is. What is today? April 6th. All right, so the markets, last I saw, the futures are up. Let's see, the markets are, oh, yeah. Oh, man, the S&P 500 is up almost 5%. All right, but either way. So might seem a little bit cherry picking now on a day like this, but I'm going to show you why you need to stay invested. So let's take a gander, shall we? How can I get that? There we go. All right. TradingEconomics.com, SPX with the S&P 500. I love it. And you can see right here, this is the track record of the S&P 500. We'll get into more on this later on, but I just want to show you here. All right, so the S&P 500 isn't just some pie in the sky dream. It's real companies that you frequent, real companies that you buy. Let's take a look at the constituents. Apple, Amazon, Microsoft. So I'm using an Apple computer here. I just bought something on Amazon the other day, or not the hell, I think like every day. YouTube is on Google. I don't use Facebook anymore. Johnson & Johnson, that's a consumer good. Bank of America, ExxonMobil, we're still using them. Walmart, I go there. Pfizer, I mean, United Health, AT&T. I mean, look at Home Depot. I was at Lowe's the other day. Chevron, Cisco, Verizon. I have my cell phone through Verizon. Procter & Gamble, I'm sure you're buying products there. Coke, Disney, Citigroup. I mean, these are the Comcast, my Infinity is my cable. PepsiCo, just talked to a guy this morning who works for PepsiCo, made a career there. Nike, unfortunately, I do have some Nike shoes. My kids like Nike. I mean, look at this. Adobe, McDonald's, Abbott Laboratories, 3M. These are the Accenture. That used to be Arthur Andersen. GE, which is getting hammered. GE still has $7, but still. Costco, I go there all the time. Bristol Myers Squibb, UPS. I mean, Lockheed Martin, they'll probably be in the world. Lowe's, Caterpillar, ConocoPhillips, Schlumberger. It's not Schlumberger, Schlumberger. Starbucks. I mean, which of these companies aren't going to be there 2 years from now? Schwab, ADP. You think ADP is going to have some issue with all the crazy tax stuff coming down the pike? There's going to be huge business demand for them because no one knows what's going on. I don't even know what American Tower is. CSX, is that trains? I mean, they're moving product. General Dynamics, Colgate, got to brush your chops. Duke Energy, Intuit, TurboTax, guys, do your taxes. Micron, Norfolk Southern, Valero, More Energy. I mean, these are the MetLife insurance companies. These are the S&P 500 companies, man. FedEx, Occidental Petroleum, Chubb, another what's it called, reinsurer, which Berkshire Hathaway. I think they do Berkshire Hathaway reinsurance too. I can't remember. Anyway, Simon Property Group will probably be in a world of hurt for sure. Estee Lauder probably be in a world of hurt because people are going to buy less. I would think less discretionary stuff. But I mean, Norfolk Southern, Valero. I don't even know what. John Deere. There you go. Marsh McLennan, another insurance company. Exelon, another energy company. Delta probably get hit on the head hard. Let's see here. Ross probably see an increase in price in Ross, or because people say I don't have enough money to go buy my Estee Lauder stuff. I don't even know what Estee Lauder is. It's a consumer discretion, right? Southwest will probably get hard. Public storage could be an increase simply because people say if they can't live in their homes and they get put out, they're gonna have to put someplace to put their stuff. I mean, so you can see this: Moody's, Fiserv, State Street, Williams Companies. I think that's an energy concern. Sempra Energy, Pioneer Natural Resources, Corning up in I forget where Corning is. Anyway, so Archer ADM. Oh, I hate ADM. Royal Cruise. I'm sure they're getting hammered. They're still at 26. So anyway, these companies aren't going. They're not going away, man. I mean, some might. Tyson Foods. I mean, you eat chicken. A lot of it's from Tyson Foods. Best Buy, Hershey. If you like chocolate. I mean, these companies aren't going away. So the idea that, I mean, these are the companies of the S&P 500. These are the companies. The S&P 500 isn't just this pretend thing. It's real companies that you probably work for, if not frequent all the time. All right, so I want to go back into this too. So let's, I want to go and show you a couple things. We're just going to look at this real quick. This goes back to, this goes back to 1928, 29. So we got, this is net of inflation. So you can see 1929, 1930, 1931, 1932. All right, so here you had significant declines, 11, well, 12, we'll say 30, 50, 15. So we had significant declines right here. The whole era of, I think it was Hoover that was running there. Then you had a pick back up when FDR won. Then you got a little bit of a fall off. Then you got people are saying, "Oh my goodness, what's happening?" But you can see lots of red. Those, basically 15 years, so lots of red in the S&P 500 net of inflation. That's bad, man. That's bad. But check this out. I'm going to show you what happened in 1920 and 1921, 1922. So I want to show you historic inflation. All right, so we got inflation rates. 1920, we had a huge inflation after the First World War ended. All right, so we had huge inflation. Then we had just this falling off the economy in 1921 and 1922. A huge decline of GDP, 10% in 1921, 6% in 1922. A little bit came back, and this is inflation. We're just going to equate inflation and GDP in the same thing. Then it came back in 1923, but not much. And then in 1924, zero. Then 1925, flat again. Anyway, 1927, 28, down. But I just want to point out something here. If you would have said, "Oh my goodness, the world's falling," and you got out of the market in 1921, you know what you missed? Well, we'll see here. 1921, the market was up 10.15%. That's with dividends, by the way. So even though in 1921 we had deflation of 10.5%, the market itself was up 10.15. 1922 we had deflation of 6.15%. The market itself was up 1922 right there, 29%. All right, so the idea that the depression, because that was a depression right here. This was depression. 1921 and 1922 was a depressionary time. Wasn't what we think about, because the government got out of the way and let people get back to work on their own. It was hurtful, don't get me wrong, but because the government stepped got out of the way, people ended up pretty good in the long run. Lots of pain, intermittent, temporary pain for sure. That sucks, and that's what we're going through right now. So let's go back. Let's just, I want to show you. Here we got, 2000, 2001, and 2. So this is what happened in 2000, 2001, and 2, -9, -12, -22. I just want to show you that these numbers are real. I got them from the Schiller database at Yale. All right, so we see positive numbers on the economy, or not on the economy, but negative numbers on the economic growth. Still had positive numbers on stocks. And if you factor in these numbers relative to inflation, which we'll do here, all right, so we're going to go to the S&P 500 at your fingertips, and we're going to start in January 1920 and go to January 1922, and your total return with dividends reinvested, with net of inflation. All right, so again, this is those 2 years that we just talked about. That was pretty bad. So 1920s, the early part of 1920s, the market was down right here, 1920 to 1921. So the market got hit 13.95% in 1920, and then it was up 10.15% in 1921. Well, net of inflation, you actually made money. You're up 4.02% as long as you invested your dividends. Now, without thinking about inflation, just the negative return, you were down 2.66% if you don't factor in inflation. But with inflation factored in, you actually were in the positive because the value of the dollar increased. Again, the point is about the dividends. Look, the dividends made you go from negative. If you reinvested dividends, you went to positive returns. If you didn't reinvest your dividends, you went negative. Look at that. It's crazy. 2.83 without investing dividends. So when you factor in inflation, that's what you got to do. It makes no sense not to. Even during that trying times, you made out like a bandit. So let's go back. We'll make this. Let's make this January 20, 1921. We'll make this. Now we'll just start with there. So what happened in 1921? When the deflation here, and so what you'll see is the inflation rate is negative 11%, but the market itself was up. Let's see here, right here, with dividends 10.1%. When you factor in a negative inflation of 11.05%, you actually had a 23.78% rate of return net of inflation. So even though that shows you, 10 is not bad, but net of inflation is 23.78. Right, and then you take 21, we'll make this to 23. So we had these 2 bad years back to back of negative inflation, And you'll see inflation rate is negative 5.97 in the overall of those 2 years. And yet your index return with full dividends invested was 26.81%. So I mean, so look, and you have CPI 19, and it dropped to 16.8. It shows you right there. The facts are you still made money even during a depressionary economy. There's just no two ways around that. We can even go to, let's say, 1927. We'll start with 1928. 1928 right there, and we'll go to 1932. 1932, at the end of 1932, and let's hit calculate. So if we look at our numbers here, 1932, we had, let's see, 1928, 11%, 12%, 28%, 47%, at the end of 1932, down 15%. So what did that show you? We got crunched. The index rate of return, don't want to go to 1928, then 1932. Yeah, right. Now we want. So we're down 12 with dividends reinvested, 12.56%. Inflation rate was negative 5.5. We had deflation. So your index with full dividends, you averaged annualized rates of return. You lost 7.48% a year in that time. This is annualized rates of return, by the way, 7.48% of the year, which is bad. But if we take the year, we actually look at it from this perspective, negative 11, negative 28, negative 40, 47, negative 15. Yeah, I must be missing a year there. Let's go back and we'll mess around this a little bit more. Let's do that to the, yeah, I don't think we want 12. Let's do 29. I want to show you the kind of 29, 30, 31. Yeah, it'd be 29. That's what we want. All right, there we go. Sweet. So here we go. Okay, cool. So the annualized rate of return during that time frame was negative 18%. From 1928, 29, 30, no, 1929, 30, 31, 32. So those 4 years, you lost 18%, which is horrific, absolutely. But if you just look at it without the context of inflation, you lost 23.5%. So on an annual basis, and that's a lot, but you factor in deflation, you only lost 18.2, which is bad. I mean, I'm not denying that's horrible, but if you look at the previous time from 1920s and 21, you actually made out. I'm just telling you, man. If you look at the previous times, we go back to 1921, right there, to 1923, right there. Hold on a sec, 1923. Yeah, right there. You made out. Even though the GDP or the price, the CPI and the GDP all fell, you still made out like a freaking champ. It really depends on what the government is going to do in the next, basically a year to two. If the government stays out of the way and just let things go back and recognize that we're going to take a short-term hit, I think we're going to be more like this. If the government doesn't, well, I mean, we could be more like it was in 1928, 1929, 30 to 1 2, but I mean, we shall see. But at the end of the day, you still are investing in these companies right here that you frequent every single day. Pfizer, Walmart, Visa, ExxonMobil. These companies are not going bankrupt, man. I mean, some might, but the vast majority are going to stay there just fine. So, I mean, again, if you think the market is doomed, then get out. I'm not. I would argue that I think you have to say all these companies are going bankrupt. All these companies are being propped up by the Fed. I don't believe it. All right, we'll see. I'd love to hear your comments.